So welcome you all in this special session of Diwali Picks Samvat 2081. So let's start the session directly. I hope my screen is visible to you all. So let's start with overview of Indian equity market. The first point is the market cap of Indian equity market to GDP ratio has reached at all-time high, approximately around 132% in FY24. Significantly surpassing its 5-year average of 84%, which we anticipate that this elevated ratio will persist as the profit after tax of Indian corporates has grown 4 times between FY20 to FY24. This suggests a stable outlook for Indian equity market. The second is the corporate profits are projected to reach 6% of GDP by FY26 estimated, reflecting a significant increase from 1.6% in FY20, 5% in FY24, a growth of 3.2 times. Corporate balance sheet has remained robust with leverage, that means debt, at a 15-year low and the sales to free cash flow ratio at 7%, indicating strong liquidity and financial health for Indian equity market. Next point is the Nifty's 1-year forward P is currently trading at 21.5 times at 16% premium to its historical average of 18.6 times. This higher valuation is partly due to the inclusion of companies with elevated P ratios. Despite this premium, we believe that Nifty is trading at a fair valuation level. Domestic institutional investors, that is DII, have continued to support the market with net purchase of 74,176 till last Friday month to date, while foreign institutional investors have sold around 80,217 crores, surpassing their sell-off during the COVID period, that is March 2020. At that time, FI sold 66,000 crore. This underscores the increasing role of influence of domestic investors in stabilizing and sustaining the Indian equity market. Key risks to monitor, that is geopolitical tension, including the conflict between Russia and Ukraine and Israel and Palestine, as well as the potential for oil prices to rise above $80 will pose significant risk to the market. Sectors to focus on. So first is FMCG and second is consumer durables. The reasons is consumption is expected to rise driven by strong monsoon, festive demand and improved consumer sentiment. And then hotel sector, the sector is poised for growth supported by higher room rates, increased demand from corporate meeting, rising leisure travels and upcoming wedding season as well. So this is pointers that overview of Indian equity market. Now let's look at Nifty's performance since last 5 years. We took a data from October 2019, which is from Diwali, October 2019. At that time, Muhurat Day was 27th October 2019, and the Nifty was trading at 11,627 level. In 2020 Diwali, that is date, Muhurat trading date was 14 November 2020. At that time, Nifty was at 12,780 level, which is around 1,153 points up in the COVID period, and the gain Nifty has given is 9.92%, which is around 10%. In 2021, the Nifty rose to 17,916. The pointer gaining points is 5,136, and approximately percentage gain is around 40%. In 2022, Nifty was at 17,730 from 17,916. The approximately points lose Nifty is around 186 points just, and Nifty closed on a flattish performance Diwali to Diwali around -1%. Again in 2023, Nifty was at 19,525 from 17,730 level. The approximately gaining points was 1,794, and in percentage term, gain was around 10% again. And in this last year, from 2023 to 2024, Nifty was at 24,854. That is in the last Friday figure. The exact gaining point was 5,328 points, and in percentage term, Nifty gave a return of around 27%. So we took a average is around 17% return every year Nifty gave. So this is a Nifty's performance over last 5 years. Now let's look at a Nifty chart on a technical basis. So this is a Nifty 50 chart. If you see a Nifty from COVID low, that is 2020 March. So Nifty was at Nifty made a low at 7,500 until 2021. Nifty made a high at around 18,600. And in this strong bull run, generally Nifty gives a shallow retracement, that is around 23.6% Fibonacci retracement or 38.2% Fibonacci retracement, that shows the strength of the bull run. And in 2022, Nifty corrected near 15,800 level, which is around 23.6% of the rally of 7,500 to 18,600 level. And after that, Nifty goes sideways. Once again, Nifty gave a breakout in year 2023. And from that level, Nifty rose around 26,277. Here also Nifty is in a strong bull run. So in this level, so 23.6% Fibonacci retracement level comes at 24,500, which is just below. Currently, Nifty trading at around 24,800, and major support placed at around 24,500. If it breaches the next follow-up support is around 23,300, which is around 38.2% Fibonacci retracement level. If you see, so this is a current rally. This is from 18,837 to 26,277. Nifty near its important support level of 23.6% Fibonacci retracement level, which is around 24,500. And next support would be at around 23,400, which is around 38.2% Fibonacci retracement level. Near 24,500, there is a multiple touch points level as well. So immediate support zone for the Nifty. Every time clients ask us that where is the major support zone for the Nifty. So if you see, Nifty has an immediate support based at around 24,500. If you see the valuation figure point of that, FI ने अब तक इतना बेचा, फिर भी मार्केट ऊपर से मतलब लाइफ हाई से तकरीबन 5 to 6% अभी डाउन है, और DI का लगातार बाइंग आ रहा है. ये मार्केट का स्ट्रेंथ दिखाता है. तो इमीडिएट सपोर्ट जो रहेगा वो 24,500 पे रहेगा. वहां वो अगर टूटता है तो ही बाद में थोड़ा करेक्शन आ सकता है, अदरवाइज मार्केट यहाँ से बाउंस बैक होने के चांसेस है. सो यहाँ पे मार्केट स्ट्रगल कर रहा है, सपोर्ट को रिस्पेक्ट कर रहा है, और ऊपर में थोड़ा प्रेशर भी है मार्केट को, लेकिन यहाँ पे मेजर सपोर्ट जो है वो है 24,500. अगर हम देखें तो अपसाइड मार्केट के लिए क्या हो सकती है, तो नेक्स्ट स्लाइड पे हम देखेंगे. The Nifty has potential upside towards 29,100, which is around a 61.8% Fibonacci extension level from COVID low 7,500 to 18,600, and intermediate support, intermediate potential level of 15,180. यहाँ पे जो प्रोजेक्शन आ रहा है 61.8% का, वह 29,000 पे आ रहा है. तो तकरीबन इस पॉइंट से निफ्टी 29,600 का लेवल अराउंड 17% के आसपास आता है. तो जो लगातार निफ्टी 5 इयर्स लगातार जो रिटर्न दे रहा था वही वो कोइंसाइड कर रहा है. 17% का अपसाइड आपको निफ्टी में दिख सकता है आने वाले दिनों में. एज फार एज द ब्रॉडर मार्केट की हम बात करें तो ब्रॉडर मार्केट यहाँ पे निफ्टी को आउटपरफॉर्म कर रहा है. फिलहाल निफ्टी थोड़ा गिरा है, लेकिन ब्रॉडर मार्केट अभी भी लाइफ हाई के नजदीक ट्रेड कर रहा है. ब्रॉडर मार्केट के लिए इंपॉर्टेंट लेवल रहेगा जो कि इमीडिएट टारगेट जो रहेगा 25,800, जो कि 100% फिबोनाची एक्सटेंशन लेवल है, और यहाँ पे 20,500 के आसपास इमीडिएट सपोर्ट है मार्केट मिड कैप 150 इंडेक्स को. नेक्स्ट जो इंडेक्स रहेगा वो निफ्टी स्मॉल कैप 250. यहाँ पे अगर हम देखें तो यहाँ पे भी ब्रॉडर मार्केट नियर टू लाइफ हाई सस्टेन कर रहा है. यहाँ पे 21,600 जो भी टारगेट है वहाँ पे भी 18% का अपसाइड मोमेंट पोटेंशियल टारगेट रहेगा, वो जो 100% फिबोनाची एक्सटेंशन लेवल है, और नीचे में जो सपोर्ट रहेगा वो 17,000 के आसपास है। सो ये था ब्रॉडर मार्केट का आउटलुक। नेक्स्ट, performance of Diwali Peak of 2023. So we gave 5 fundamental picks in the last year and 3 technical picks. So for fundamental picks were Dr. Reddy's Laboratory, Union Bank, Oberoi Realty, PI Industries, and Greenlam Industries Limited. All 5 fundamental picks achieved their target. And if you took a position of 1 lakh each, then on a 5 lakh you earned 97,000 profit, approximately around 19% return the portfolio give. And in technical, if you see technical picks, so macro tech developer we gave, that is Loda from reality sector, and we recommended at 849, the target achieved of around 21%. However, Tata Consumer Products also achieved their target of 25%, and Credit Access Grameen hit stop loss of around 9%. So here also, if you see 1 lakh position each, so 3 lakh, so you earn one can earn 38,000 rupees, and the percentage was around 13%. In this scenario, Nifty, our target of Nifty was 19,500 to 22,000. This was also achieved. Nifty made a high at around 26,277. Here also all the stock जो कि हमारे टारगेट से भी काफी ऊपर गए। डॉक्टर रेड्डी का हमारा टारगेट था 6,100, जो कि हाई मेड अराउंड 7,100. यूनियन बैंक also made a high at 172. Our target was 137. So market gave a phenomenal return in the last year. So that's our performance of Diwali Picks. So now I'm handing over to Neel for current year's technical pick. After that, Dibandu will share his fundamental pick also. So thank you all, and over to you, Neel.
Thank you, Vidyan sir. Yeah, so first of all, Suswagatam everyone in our Diwali Peak or 2024 webinar. So in technical front, we have selected the shortlisted 3 stocks based on the diversified sectors. The first sector is being from consumer durable, second is metal, and the third is breweries and distilleries. So from the consumer pack, we have a consumer durable pack. We have selected the stock as Voltas. I'll just share my screen. So this is the first stock that we have selected, the Voltas. This is a monthly chart of Voltas Limited. If we look at the broader horizon, the stock has been making a rising bottom formation, and subsequently it has been witnessed a change in polarity on the 3 instances. The first instance was this area, the middle area of the chart pattern. If you look at, the stock has been underperforming from 2008 to 2016 level. Then it witnessed a change in polarity where the prior resistance of 2008 and 2010 has been acted as a strong support zone and 2016 level, and witnessed a sharp rally of 250% price growth. If we zooming on the current price structure, the current scenario, it has been witnessed a change in polarity again on Jan 2023, where the resistance of 2020 has been acted as a support level. From there, again, the price has surged towards an approx of 100% price growth level. Further zooming on to the recent price structure, on June 2024, the very recent monthly momentum candle has been witnessed at similar polarity level from the level of 2021, October 2021. The similar repetitive pattern of polarity signals us the healthy trend. It showcases that the prices are not getting closing below the pivotal area, which showcase the buying interest has been persistent in the Voltas Limited. So on the upper end, we are analyzing the first as a price chart, and on the lower end, I have drawn the ratio chart. So before getting into the ratio chart, I'd like to highlight some importance of ratio chart. So in technical, we are analyzing, firstly, we analyze the price behavior, how the price has been behaving. So that we can get an idea of trend, whether is it trending, rising or falling, or is it sideways. But with the help of ratio chart, it also takes us one step ahead. Based on the Nifty and the Voltas Limited comparison, the Voltas divided by the Nifty, we get a ratio chart that we have drawn on the bottom area of the chart. That helps us to understand how our stock is been performing compared to the broader indices. So in this case, I have selected Nifty 50 because it's a benchmark index for Indian equity. So how Voltas is been behaving comparing to the Nifty 50 index. So if the Nifty 50 index is falling by 10%, for example, how Voltas has been reacting to that phase. So the ratio chart has been drawn. It also showcased a change in polarity has been happening. The prior resistance of 2006, 2007, 2010 has been acted as a support level at July 2023. From there, the stock has made a beautiful base pattern and witnessed a breakout of the recent swing high of Feb 2022 and maintaining a higher top and higher bottom formation. That denotes the stock has been consistently outperforming the broader indices. Based on this relative strength method, we have selected, and also the price structure that has been witnessed, the polarity range shift structure that has been showcased. It showcased that the stock is in the good upward trend and with a healthy momentum. Zooming on to the weekly time frame chart. So after the breakout that has been witnessed of the double top formation on December 2023, the stock has been consistently maintaining a bullish mean reversion where the 12-week exponential moving average, the first wave line that you are seeing, it's a 12-week exponential moving average. Every time the stock has witnessed a dip, it has been bought back from this average, which is a 12-week exponential moving average. The first instance was at the level of December 2023. Second was at March 2024. The third was at August 2024. Now, zooming on to the recent price action. Recently, also the price has been taking a support of 12-week exponential moving average, and it's been ready to get a bounce towards higher territory. So the monthly and the weekly time frame chart suggest us the stock has been ready to poised for an upside target of 2368 level, for which is an 27% upside potential from there. I'll just showcase the report that we have mentioned. In this report, we have detailedly mentioned about the price behavior, the ratio chart, and the averages momentum that has been witnessed on the chart pattern. So our upside target, as discussed, is 2368, which is an upside potential of 27%. And the stop loss to maintain in this particular stock is 1660 level. Now, moving forward to second stock, which is from metal industry, National Aluminium. So this is also a monthly chart of National Aluminium. So if we are witnessing that from 2008 to 2022, the stock has been in a consistent underperformance zone that has been marked on with the help of orange rectangular pattern. And zooming on to the 2022 area, it has been witnessed a polarity of 2008 resistance, 2010 resistance, and 2017 resistance. So three multi-year swing high resistance has now been acted as a support level on to 2022. Since then, the stock has been consistently maintaining a rising trajectory. If we look at the moving average of 12-month and 26-month moving average, this is an EMA, exponential moving average. It's been consistently rising with the price structure. That also showcase the stock has been now emerged from an underperformance zone to an outperformance criteria. This price theory has also been verified with the help of the ratio chart, which has been drawn on the bottom area of the chart. If you look at, I have drawn the blue sloping line, which has been showcasing a breakout on November 2023. This breakout has been adjoined, trend line has been adjoining from 2008 to 2008 swing high to 2020-21. That has been witnessed a breakout at November 2023. If you look at the ratio chart on the monthly scale, it's just popping up from the trend line breakout. The higher potential of this particular national aluminum price growth with the help of ratio chart we are analyzing, it's much more than the current market price. Currently, the national aluminum is at its all-time high level, but it's not a cap. The ratio chart help us to understand there is much more to come in national aluminum stock. Is just because on the monthly scale is just pop up from the breakout level. There is much more coming up till the level of 450 on the ratio chart. So we are expecting a target price of 290 for the national aluminum, which is an upside potential of 25%. Also, zooming onto the weekly scale, the recent structure has also witnessed a polarity, the range shift level. At the current, firstly, it is witnessed on September 2024, and on the recently October 2024, on the prior week, it has witnessed a pivotal shift level. Similar on the weekly scale, the ratio chart is forming a higher bottoms. So that also signifies us this current market price is not just a cap; it has a much more potential to witness on the upcoming sessions. Now, the third stock we have selected is TI, which is Tilak Nagar Industries. This stock is from the beverage and distilleries sector. So this is a higher time frame chart of TI Industries, Tilak Nagar Industries. If we look at from starting peak point on 2010 to 2019, the stock has been consistently making a lower tops and lower bottoms. That means it has been consistently showcasing an underperformance compared to broader indices. Thereafter, 2019, the stock has steadily showcased an higher tops and higher bottom formation structure. And finally, on June 2023, it has been witnessed a breakout of its multi-year high of 2010, forming a big base breakout level. So in technical term, this chart pattern showcase and stock is been ready to come up in the new territory of bullish momentum phase. Zooming on to the recent structure, the stock has been consistently, after the breakout, the stock has been consistently maintaining its higher bottoms. And now it has been also showcasing a range shift scenario on the weekly scale. If we look at the volume participation, since the breakout, the volume participation has been increased more than the 20-week exponential moving average of volume. That also signifies the buying interest has been coming up on the stock. Similar, the ratio chart on the bottom area of the chart, you can see the ratio chart has been drawn. It has also been witnessed the polarity level of change in polarity of the prior resistance of 2014, which has now been acted as a on 2024 now been acted as a support level. If we closely look toward the support, it has been made and double bottom formation on the polarity level. So change in polarity with the double bottom formation on the ratio chart itself signifies the potential promising setup that has been made on TI Industries chart. Similar kind of structure that we are witnessing, the ratio chart is also signifies this is not just the end, it is just a beginning of a new era of a uptrend territory. So in this we have marked a higher target of 301, which is an upside potential of 30%. And in this we can stop loss of 267. So that's it from my side. I'll hand over to Dibandu for fundamental picks.
Okay. So, the first Diwali peak is our Indian hotel. So, if you know, it is the largest Asian hotels, and this belongs to the Tata Group, and they have well-known brands in hotels such as Taj, Sequential, Vivanta, Ginger, Cumins. These all brands belong to the Indian hotels, and as well as they have scalable presence in terms of domestic and international also. So, coming to the first key rationale is they have diverse hotel portfolio, and they have key brands in key cities. So, what do I mean by this? So, they have currently have 22 operational hotels at currently, which caters to international and global also under this brand name as Taj, Sequential, Vivanta, Ginger, Cumins. So, as well as they have 103 hotels in pipeline, which will be coming by Q1 of FY26 and Q4 of FY24. As well as they also cater to luxury segment also, upper scale segment also, and mid scale segment also. So they have diverse segmental scales. So 70% of the hotel rooms are belong to a luxury and upper scale segment, whereas the rest belong to the mid scale segment. As well as they are present in tier one cities also, and they are also present in uh, tier two cities also. Majorly, they presence in tier one cities like Mumbai, Delhi, and Bengaluru. So, coming to the second key rationale is currently the hotel sector is favorable. Why? Because they are facing a demand supply mismatch. So, why this is happening is because the demand of the room is growing by 10%, whereas supply of the room is just growing by 8%. So, why this is happening is because of the higher real estate prices in tier one cities. And if we look at the demands, so demands are scaling at 10%. Why? Because of the growing leisure travels, corporate meetings, and upcoming wedding events. For this reason, the hotel sector is seeing a huge demand and lesser supply. Uh, because of the high real estate prices, especially in the tier one cities like Mumbai, Delhi, or Bangalore, and it also include Pune also. So for this reason, they are seeing a double-digit growth in average revenue room rent. So for this, their profitability has shown a good growth, and also in PAT also, and in EBITDA margin terms also. So if you look from the post FY20, so if you look, the Indian hotel was able to grow at 32% margin. If you see margin at FY21, that was barely at 14%. Today, Indian hotel is able to capture 32% EBITDA margins. So why this happens? Because of the double digit ARR growth. So this was our second key rationale. Coming to the third, they have they are strategically shifting towards management contract. So in hotel business, we have two type of business, which is the own hotels, and second is companies are run through management contract also. So in own hotels, they have their own properties, they build the property, and they run this business. But in management business, they acquired some of the hotel portfolios and renovate that portfolio, and run through their brand names. And for that, they take a management fees from the hotels. So what is the benefit of moving towards management contract? Firstly, if you have to build a hotels or acquired land, you will have to take a capital. You will require a highest capital. The required of capital will be high, so you have to take borrowings also. So in terms of Indian hotels, the debt to equity is on controllable side, whereas if we look at some of the peers like chalet hotels, which is the own hotel, which is run on own hotel model, so their capital requirement is very high and they have high debt. So for this reason, the if you look at the Indian hotel ROE, ROC, that are more favorable than any of their peers. So, if we look at the valuation, currently the Indian hotel is trading at a 39 times of EV by EBITDA, and we valued at 37 times of FY25, FY27 EBITDA. So we recommend buy on Indian hotel with target price of 859 rupees from the current market price, which is 687, which gives us a 25% upside. Coming to the second pick is our pick is CDSL, which is Central Central Depository Security Limited. So this company is in monopoly market. So we have two depository business, which is CDSL and NSDSL. So CDSL is the listed peer. So if we look at their first key rationale is the revenue drivers are their higher retail participation and their higher market share. If we talk about CDSL market share, so they have dominant market share. Currently, they have a market share of 76% in the Demat opening. And as of June, CDSL has registered 12.5 lakh crore registered Demat account in their business. If we compare this figure with 1 year, which is June FY23, which is a 42% growth. So how the revenue will grow ahead? So there are two triggers, which is higher retail participation. यानी कि if retailers अगर डीमैट ज्यादा ओपन करते हैं, if retailer participates in equity market, so company will be benefit from that, as well as the higher market penetration. If current market penetrations की बात करें, तो it's somewhere around 8% market penetrations के around है, जो कि expected है by FY30 तक कि ये 13% के penetration level तक जाएगा. So if this happens, the CDSL will be a sole benefiter, which means if penetration will increase, it means the higher retail participations in the market. So this will be the first key triggers, and we project 11 to 12% CAGR growth in their profit. Coming to the second key rationale is the high operating and fixed nature cost. So what do I mean by this? So जब भी आप कभी भी ऐसे टेक्नोलॉजिकल कंपनी को इफ आप एनालाइज करते हो, तो यहाँ पे हाई ऑपरेटिंग लेवरेज का एक एंगल आता है, और इनके जो मेजर कॉस्ट जैसे कि एम्प्लॉय कॉस्ट और जो टेक्निकल कॉस्ट रहता है वो फिक्स्ड रहते हैं. सो लेट मी एक्सप्लेन बाय दिस. सो CDSL जो कि मेजरली इनका जो बिजनेस है वो टेक्नोलॉजी, बिकॉज आप डीमटेरियलाइज करके डिजिटल शेयर्स इनके सर्वर पे स्टोर करते हो, तो मेजर इनका जो एक्सपेंस रहता है वो टेक्नोलॉजी सर्वर बिल्ड करने में जाता है. सेकेंड थिंग इज कि उस सर्वर को रन करने के लिए IT एम्प्लॉयज को हायर करना पड़ता है. तो दोनों ही इन टर्म्स ये फिक्स्ड इन नेचर होता है, यानी कि आपका कॉस्ट तो फिक्स रहेगा. आपने एक बार जो अपना इन्वेस्टमेंट कर दिया सर्वर पे, वो बार बार रिकर नहीं होता है. आपको हर साल कैपेक्स नहीं करना पड़ता है, विच इन टर्म्स मैन्युफैक्चरिंग बिजनेस में आपको बार बार आपको कैपेसिटी एक्सपांशन करना पड़ेगा, तब जाकर आपका यूटिलाइजेशन इंप्रूव होगा एंड वॉल्यूम जनरेट हो. सो इन केस ऑफ CDSL ये चीजें नहीं है. सो इनका कैपेक्स कम रहता है, तो आपका ROE ROC काफी हाई रहता है, और एम्प्लॉय कॉस्ट फिक्स्ड इन नेचर कॉस्ट होता है. आपने एक बार इस साल इंक्रीमेंट कर दिया तो आपको मंथली या क्वार्टरली बेसिस पे इंक्रीमेंट नहीं करना पड़ता है. सो बट आपका जो क्वार्टरली बेसिस रेवेन्यू है वो इंक्रीज होते रहता है. सो इन टर्म्स ऑफ रेवेन्यू जो आपका एक्सपेंस रहता है वो काफी फिक्स्ड इन नेचर रहता है. So if अगर हम FY22 से FY24 तक CDSL का EBITDA मार्जिन्स कंपेयर करते, सो EBITDA इनका FY20 में 89 करोड़ का था, आज ये 488 करोड़ का हो गया, जो कि 4 टाइम्स ग्रोथ है FY20 से लेके अभी तक। हाँ, so this is has been a huge in terms of margin. So purely ये जो है operating lever play out हुआ है. So if हम लोग margins की बात करें तो पहले ये margins 40 के आसपास था, आज ये 60 to 60% का margins पे ये run rate पे चला गया, and we expect कि ये 61 to 62 के आसपास ये margins continued रहेगा. Third key rationale is their strong financial and low operating leverage. As I said you earlier कि इनको कैपेक्स काफी कम लगता है, तो if we look debt in their balance sheet, it's barely 1 crore. If हम cash positions देखें, that is around 23 crores as in investments, liquidity investments देखें, तो that is more than debt. So in that case तो इनका interest cost भी काफी low होता है, as well as depreciation cost भी काफी low होता है. So ये काफी huge beneficial है इनको कि जो भी revenue आता है, then higher operating margins, and then it's directly pass on to the PAT. So ये काफी high growth stock है. So currently CDSL is trading at a 60 times P, and we valued at 49 times, and based on that we recommend buy on CDSL with a potential upside target of 2017 rupees, which is a 28% upside from the current market price of 1578. Coming to our third pick is Jindal Saw. So Jindal Saw is mainly into manufacturing of steel pipes. So they have two business divisions which belongs to the steel pipes and iron pellets. So major revenue comes from their iron pipes only. So if we talk about the iron pipe portfolio, they have ductile iron pipes, so which are used for the transferring of water from one source to another source, and also they also produce saw pipes which are used in chemicals or oil industry for transferring the petrochemicals or transferring the fluid chemicals or transferring the oil from one source to another source. So coming to their first key rationale is their deep bottlenecking and their value added product. So currently company is focusing on the value added product where the margins should be are very high, and this is they are doing through their subsidy named as Jindal Hunting Energy and Services, and also they are looking to increase their capacity expansion by 10 to 20%, and this capacity expansion is done on the basis of debottlenecking and not by through adding further machineries. So यहाँ पे capital requirement काफी कम है, but debottlenecking के through better volume growth and based on the back of the better utilization, they will aiming to achieve 2 lakh tons production, and by next year they are expecting to achieve additional 50,000 tons by the next year. Second key rationale is their healthy order book. So they have order book of 1.65 billion dollars order book. So 32% of the order books come from the export, so which also gives their export opportunity income also. And mainly this order book is comprised of steel pipes, and rest 15 millions come from the pellet. And if we talk about the sector specific, so 70% come from the water sector and rest come from the oil gas sectors. So coming to the third key rationale, so the industry which is tailwind in industries. So industry is expected to benefit from the company is expected to benefit from the current government capex, which government has allocated 11 crore towards infrastructure. So government also is currently focused on water infrastructure also, which the company has ductile iron pipes. So majorly comes from this pipe. The revenue comes from this pipe. So company will be very beneficial in terms of this. So currently the company is trading at 11 times of P, and we valued at 9 times of P, and we we arrive at a target price of 471, which is a 27% upside from the current market price. Coming to the fourth pick is our LT Foods, which belong to the FMCG sectors. If we talk about what LT Foods does, is mainly they sell rice. So they are global leaders in selling the rice. They have three business division. First is they sell rice. Second is they also sell natural ingredient products, which includes dal pulses and all the pulses which include in the LT Foods second segments. And third segment is ready to eat foods. So these are the three key segments which they operate. So majorly 89 to 87% income from by selling rice. So if we look their key brands like Dawat, Royal, and if we and next is Eco Life, and third brand is there. Uh, Ecolife, and third brand is the Divya, which also sell staple rice of India. So they have diverse product portfolio in terms of rice. They also sell brown rice and some healthy rice, which is included red rice. So they have diverse variety of rices and diverse product portfolio. If we, first is their key rationale is they have dominate market share position in terms of international business also, and in terms of domestic business also. If we look at the domestic business, they have 30% market share in India, uh, as well as in out of in North America they have closely 25% market share, and in US they have 50 plus market share. So if we look about their expansion, and they have a very good market share in terms of both international and national. So as well as company is looking to increase their market share in domestic by 30 to 33% in next 5 to 6 quarters. If we talk about their past performance, uh, company has grown their revenue by 31.5% CAGR, and in terms of volume, they have grown by 20% CAGR. So these figures are very much attractive if we compare with their peer competitors, which is Cable, which has barely showed a 9% or single digit growth in last 3 years or 5 years. So if we talk about the distribution network, they have 1,200 distribution network and 176,000 retail outlets in India. Coming to their second key rationale is they have a diversified revenue profiles. As I said, they operate in more than one. So apart from selling rice, they are in also packaging food also, and in some of the green pulses also. So they have presence 80 plus country, which 70 to 60% revenue come from the export. And if we talk about the another segments, which is the green pulses, so their growth is 12% CAGR in that segments, and they have a healthy market share in terms of green pulses or healthy lifestyle food also. Third key rationale is they have a biggest opportunity in UK. So they are seeing a 1 billion euro business in UK. So currently they have invested 7 million euros for setting plants, and this will be done in two phases. First phase will be 7 million investment, and Next phase will be a 50 million euro investment, and they have a production capacity of 60,000 tons per year. So and they are looking for 50 million revenue opportunity in next 1 year, and after the 5 year they are expecting 100 million euro opportunity. So this is the biggest opportunity for LT Foods they are capturing in the UK. So we expect that LT Foods will post a healthy growth in the coming year. We model 15% CAGR growth in revenue, and we expect the margins from here on will grow incremental basis. So currently they have 12% EBITDA margins and expected to go by 14% by FY27, and we expect profit to grow by 13% CAGR over the FY27. So currently the company is trading at a 20 times of price to earning, and we valued at 14.9 times, and we arrive at a target price of 512 rupees, which is a 22% upside from their current market price. The last pick we have a Sangvi Movers. So just giving a view, what does a Sangvi Movers do? So they are in crane rental business. So any infrastructure company who build bridges or metro bridges or any development, you require a crane for lifting heavy equipments. So Sangvi Movers, what basically does is they rent a various crane to their customers. So coming to the first key rationals, they have dominating market share with diverse portfolio. So if we talk about the crane rentals, they in India they have 40 to 45% market share and 60 to 65 market share in higher end crane rent market share. So if we talk about their product portfolio, currently they have 361 cranes, which caters to 220 metric tons to 1,000 metric tons. So 1,000 metric from 800 to 1,000 metric tons are the high-end cranes, which they have market share of 60 to 65% market shares, and also the major incomes comes from the windmill sectors. So this is their key sectors where 46% revenue comes from the windmill sectors, and rest come from the wind EPC, oil refineries, steels. So these are the major contributor of their revenue. Coming to the second key rationale is there is a turnaround in second half of FY25. So currently, if you look at the Q1 FY25, the revenue growth and the result was on a softer note. So major reason for this was the general election and the monsoon. So for these two reasons, so there was a lower construction, and due to the monsoon also the construction activities are very low. So for this reason, the crane rental was on very lower pace, and the capacity utilization was around at 77% from 84 earlier. So that's why the company has taken hit and expected to remain soft in Q2 because of the monsoon. But post Q3 and Q4, there is a turnaround as management is expecting 80 plus utilization capacity and 2% plus rental yields. So currently they have order book of 774 crore, which if we split, so 330 crores come from the renewable space. So company has a good set of order book, and they are expecting a good turnaround from post FY second half of FY25. So there will be a 80 plus capacity utilization, and will be a rental yields of more than 2%. So based on this, we recommend buy rating on the Sangvi Movers with the if we talk about the valuation, that is trading at a 14 times of P, which is a sharply trading at a discount, as they have historical median P of 23 times. So we valued at 14 times on a FY27 earning basis, and we arrive a 600 price target, which is a 31% upside. So quickly coming to the snap of the, so these are the picks we have recommend on fundamental basis, and we have potential upside of 31 on the higher side, and on minimum side we have a potential upside of 22%. So that's it from my side.